Hello and welcome to Berkshire Beyond Buffett. I'm Jared Blickery, and for the next half hour, we're taking you inside the leadership transition at Berkshire Hathaway. The Oracle of Omaha, Warren Buffett, is stepping away from the CEO role at the start of the year, and Buffett began his transformation of Berkshire into the conglomerate we know today way back in 1965. And over the decades, he has added dozens of businesses to the portfolio, including brands you know, like Geico, Dairy Queen, Brooks Running, and Benjamin Moore. We're going to hear from shareholders who will provide insight and analysis on what to expect when incoming CEO Greg Abel takes the reins. So let's dive right in. Before you hear stories from investors, I broke down the key business and growth drivers for Berkshire in an earlier edition of Stocks in Translation. In just a few weeks, Warren Buffett will no longer be CEO of Berkshire Hathaway, a job he's held for 6 decades. His number 2, Greg Abel, will take the reins. But this isn't a retirement story. Buffett is still chairman of the board. It is, however, a succession moment for one of the most unusual, most successful companies in history. And for anyone who's ever looked at this stock and wondered what it's all about, on today's Stocks in Translation, we are breaking down Berkshire basics. Berkshire is not a normal megacap. It's a holding company with 3 distinct engines. The first is its operating business. These are companies that Berkshire owns outright. They throw off real cash flow year after year, good times and bad, a Buffett staple. Engine number 2 is the Berkshire stock portfolio, which probably gets the most attention. It holds big stakes in many public companies, with Apple as the largest. And despite Warren saying that his favorite holding period is forever, there's a decent amount of trading churn in the portfolio from quarter to quarter, and Buffett has slowly given up control over its stock picking decisions since 2010. Engine number 3, and this is the quirky one, is Berkshire's insurance business, including what's called the float. Insurance companies collect money from premiums first and they pay claims later. And that in-between float money can be invested. That's a structural advantage that many companies do not have, and it helps explain why Berkshire can afford to be patient when others cannot. Now, let's check out a Berkshire stock chart. And here we're comparing Berkshire to the S&P 500 over the last 5 years, which includes several market cycles. And you can see Berkshire's up 120% versus 80 for America's benchmark index. And you can credit the higher return to Berkshire's ability to hold up better during both the 22 bear market and during the post-Liberation Day sell-off earlier this year. And while the rest of the market started soaring in mid-April at the right of the chart, Berkshire has lagged a bit, and many credit the overhang of Buffett's departure, which only means that 2026 could be a defining year for the conglomerate. Now let's take a look inside at the many businesses that make up Berkshire's own mini real economy. Starting with Geico, their insurance business provides a real-time risk on risk pricing across the world. And through its BNSF Railway, it gauges freight, shipping, and industrial demand. And Berkshire Hathaway Energy, not surprisingly, gives a read on the energy markets, including business investment spending and the power grid. In manufacturing, it has Precision Castparts, which provides a window into aerospace and industrial orders and demand. And Berkshire has a bunch of household brands, from Dairy Queen to Fruit of the Loom to Brooks Running Shoes. Along with its McLean Supply Chain Services business, it has many eyes on the health of the consumer. Finally, from services like flight safety, it gets business travel and training insights. So Berkshire doesn't just track the economy, it lives inside it. And then it brings to us that next question: what happens next? As 2026 kicks off with Abel at the helm, we're going to want to pay attention to Berkshire's capital deployment, as this is always the game. When do they move? When do they sit on their hands? Because investors have been wondering for the last decade when Berkshire will shell out cash for a big buyout. Will Greg Abel be just as willing to wait for the fat pitch? Meanwhile, that cash pile sits north of $300 billion, and it is growing. Next up is stock buybacks. Buffett has always been clear. He's only going to buy a stock, including his own, when the price is attractive or wonderful. So watch that closely. Then there's insurance discipline, the quiet engine. If that stays tight, the whole machine stays healthy. And finally, watch the communication tone and listen to that. We might miss the marathon Q&A sessions and watching Buffett hold court for hours like a folksy oracle behind a can of Coca-Cola, but clarity is what matters. And now a closer look at some of the key decisions Warren Buffett made to make Berkshire Hathaway what we know today. Portfolio Wealth Advisors President and CIO Lee Munson explained how the insurance business, especially Geico, were crucial in the company's growth.
It's the total engine behind Berkshire Hathaway. Now, a lot of us like the old Warren Buffett grandpa with his sweater, telling stories by the fireplace about See's Candy. And most people have heard about he bought See's Candy and he used all the cash flow from See's Candy to buy other things. Not unlike what Philip Morris did during the last century of taking all the money they made from cigarettes and buying cheese companies, right? But more profoundly, it was always really about Geico. I think that we talk about the See's Candy story because it's easier to understand, but he bought Geico and then basically he made all of his policyholders investors, because what he got with the float from Geico, you take money in for insurance and then what you don't pay out in claims, you can invest. Well, he was one of the greatest investors of all time, so he had a source of capital that had very, very low cost. It was liquidity that, he didn't have a liquidity problem with investors saying, hey, we need to nab this cash. So his ability to look forward into the future and know how much cash flow he was going to get made it a lot easier to take over companies and to buy things and have a schedule. Nobody had done this up until Buffett.
Well, as you say, there's this sort of image of him as this sort of grandfatherly figure, but that's also calculated in some ways. It can be authentic and calculated at the same time, I suppose. But the way that he communicated with investors, in addition to the shareholders meeting, was through his annual shareholder letter. How did he use that as a tool?
He used it for social engineering. He wanted to engineer his client base. He wanted to make sure that he was selling long-term value. He wanted to be sure that he was the original Bitcoin tout, right? He wanted to make sure that people bought Berkshire and held it forever and never sell your Berkshire. And so not only was the structure designed that way, not only did he have permanent capital, but through his letters, he would talk about moving beyond volatility and not having to think about volatility, talking about a margin of safety. Everything he bought was, a value. He was buying dollars for 50 cents. And on top of that, he was a salesman, right? He talked about underperforming during bubbles and that compounding was really the way. And I think he convinced people that the moats were really about competition. I think that was one of his greatest magic tricks, because really what he invested in through the most part of his life were monopolies and places that didn't have competition and were not based necessarily on the innovation of America, but was based on companies like an Apple computer that just had all the cards. And I think he made people comfortable with that type of, monopolistic oligopoly inside of America.
Lee, how many of these things do you think will continue at a post-Buffett Berkshire Hathaway, right? I mean, obviously the structures, which were sort of original to Berkshire and Geico, they're already in place. But, the letter and sort of how do you think that all evolves?
Well, I think it's going to stop, right? I always look at book value versus the price. We've had times where the net asset value of Berkshire has, gone negative. Here's what the thing is. Buffett's legacy is the architecture of Berkshire Hathaway. His legacy is how he did this. Greg Abel, I'm sure, he's a brilliant guy. He knows how to operate. He's been doing it for years. This transition has been signaled. It's nothing new. Everybody on Wall Street knows. But we're not going to have the magic duo of Warren Buffett and Charlie Munger telling these stories and keeping investors focused, solid. And also, those Berkshire Hathaway shareholder meetings were also sales productions to get people to buy the products that Berkshire had bought within its holding company. So do I think that the operations and the culture will stay the same? Absolutely. But how are we going to get that next generation of disciples of Buffett who just buy that stock and never, ever sell it? That remains to be seen.
Next, hear directly from two Berkshire shareholders on what they want and expect to see from Greg Abel, Warren Buffett's chosen successor. Greg Abel is taking over for Warren Buffett in the new year. But with new leadership, many come new moves, even though Abel has been at the company for 25 years. Jonathan Boyer, president of Boyer Research, sat down with Yahoo Finance's Josh Lipton and spoke about what differences he expects to see.
Warren Buffett is known to be a hands-off manager. He has a decentralized structure. Many businesses sold themselves to him because they wanted the autonomy to do whatever they want, and that's obviously worked out extremely well for Berkshire over time. However, by having this decentralized structure and not having management oversight, there's probably a lot of fat to cut. There's probably divisions that could be consolidated. There's many things that they could do to enhance profitability that Buffett just hasn't wanted to do. Buffett is the greatest capital allocator and the greatest investor of all time. He's not known as the best manager of all time. Greg Abel might be able to do things that he wouldn't or couldn't do.
What could Greg Abel do with that giant cash hoard? What would you like to see him do with it as a shareholder? As
a shareholder, I mean, the amount of cash they have is excessive. Since Buffett is going to be gone, he's the greatest stock picker of all time, I'd like them to de-emphasize the actual stock picking. I'd like them to start paying a dividend. Hopefully over time they do that. That might not happen right away, but it would be a nice thing. I would like them also to buy back shares. It'd be great if they could make acquisitions, if they could find them. Unfortunately, a company that size, it's hard to find an acquisition that's cheap that also moves the needle.
What do you think, Jonathan, Greg Abel can do to try and, as quickly as possible, sort of earn the street's trust? Like if he came to you, Jonathan, and he was asking you for guidance on that topic, what would you tell him?
Well, I would love for him to give me a call. But one thing I would like him to do is, he owns a fair amount of Berkshire stock, but all of that was bought when obviously Buffett ran it. To me, a great sign for Wall Street would be for him to buy an extremely large amount of Berkshire stock personally and really put his money where his mouth is.
As a shareholder, how much leash you want to give Greg Abel to prove his merit here? I mean, do you give him what's the time frame, Jonathan, for you? Is it 1 year, 3? Is it 5?
Listen, we're long-term patient investors. Buffett has created a business that can basically run itself. You want him to be a great steward of these assets. You want him to go in and manage them better. And I think after a 3 or 5 year period, you would be able to see, is he doing a good job or not? And I don't think you can judge anyone on a 1 year period.
You say here, the days of extraordinary returns are behind Berkshire. So as a shareholder, what would be a more realistic return profile, do you think?
I mean, I think over a 3, 5, 10 year period, I think it should be able to beat the S&P 500. I think, certainly the returns have been massive historically. I mean, it'd be impossible, the law of large numbers comes into play. But I think it could be a very good long-term core holding for people. That's a good diversification away from the tech-heavy, S&P 500 and NASDAQ.
What have you been doing with your own position here, Jonathan? You've been holding steady, trimming, buying?
We've basically been holding steady. If for whatever reason shares dip because people are worried that Buffett is leaving, I would view that as an opportunity to buy more.
What are the negatives, if you can try and quantify them or qualify them, of Buffett leaving? He is the oracle. What do you think can't be replaced?
Him. I mean, he is the secret sauce. People love to do deals with Warren Buffett. He got the great deals during the financial crisis. But over the last couple of years, with the exception of Allegheny, most of the deals, they haven't done much, and the deals that they've done have not been good, which is partially a result of their size. And also that PE is much more involved than ever before. So I think he will obviously be missed. I wish he could stay CEO for another 10 or 15 years, but he certainly earned his retirement.
In your opinion, Jonathan, I'll get you out of here on this, greatest value investor of all time?
Absolutely, hands down.
How so? Why so? Explain that for us.
Because he's done this for a period starting in, I believe, the 50s and 60s up until today. I mean, the longevity that he has, the discipline that he has. He did it as a hedge fund manager. He's done it by investing in companies, buying back his own shares. He's just a fantastic capital allocator.
Meantime, Julie Hyman spoke with long-term Berkshire Hathaway holder Bill Stone of Glenview Trust about what matters most in this transition.
Don't try and be Warren Buffett, following the greatest of all time, and certainly, throw Charlie Munger in the greatest duo of all time. Trying to beat them at their game, so to speak, is probably not the right thing. It's also a different company that it was when it started. It was a failing textile company, and they turned it into a massive, successful conglomerate. We now have a massive, successful conglomerate. So I think it leaves you with, I'm just going to essentially take right from what Warren Buffett has laid out, which is how he would really judge management if he was on the outside, which is watch for them to grow operating earnings over time. Secondly, decrease share count. And he's got a couple caveats on that. You want to do it when it's the right time to do it. Buy shares when it's below intrinsic value, so you're not diluting shareholder wealth. Also, if you buy those shares in, you're growing operating earnings for share at an even faster rate. And last but not least is look out for big opportunities. And that is really two things about that. One is Berkshire Hathaway is so big now that you have to find bigger opportunities to move the needle. Two is they have the balance sheet and $380 billion in cash. So they're one of the few, or, amongst the few that, especially when times are tough, can actually take advantage of those. And I think if you looked back at Buffett and Munger's track record, a few very good decisions was the majority of the great performance. Now, I will say they avoided making very many disastrous decisions, certainly made no large scale disastrous decisions. So that's also an important part of it.
Well, and I guess that's my next question about Greg Abel is it a matter of more of avoiding mistakes and sort of steering the ship than it is sort of finding those big investments and big bets to make?
Yeah, I mean, I think you're probably right that it's tilted a little bit toward the, maybe I'd say toward managing it more, managing the conglomerate more, certainly more than Buffett and Munger did, which was frankly very little because they didn't enjoy doing that. And then secondly, you really can't force the opportunities. You have to, find them along the way. That certainly is a major part of it, to grow and to find opportunities. But you're probably right that some things have maybe moved more to the forefront.
You were a long time sort of student of Buffett and Berkshire shareholder. And I wonder kind of how his sort of lessons have filtered down into your investing.
Yeah, I think so personally. So I was at Salomon Brothers when he took over and saved the firm. So it meant a lot to me. So I think one thing I always think of, my family didn't come from the business, but so I kind of got exposed to it through Gordon Gekko and Liar's Poker by Michael Lewis. And I would say, one of the things is you don't have to be like, I'll say those villains or whatever. Shouldn't maybe say that about my coworkers at Salomon Brothers, but not all of them. But at least I think you can act a bit differently. I think the next part is just really quite amazing that he viewed it as a duty to, to gather more wealth, but really just in the end to give it all away to society. And I think that's some really, touching parts of it. When you go to the more investment side, I think he's been amazing in getting Benjamin Graham's ideas out there, where you just say stocks aren't pieces of paper to us or to me. They are really looking at a company, and that's how I think about them. And, that was a big part of my change to thinking of it that way. And lastly is kind of the thing we all, as value investors, think about is the margin of safety. Can I buy this with enough margin of safety that if I made a mistake in my analysis, I don't have a catastrophe on my hands? That's a big part of it. And it really gets to my, or things he said, which I certainly believe, which is all investing is value investing. So while we in the industry kind of break things between value and growth, the fact is what you pay for something, whether it's a company that's growing earnings fast or not, matters.
Stick around for more perspective on Berkshire Beyond Buffett. If you're thinking about investing in Berkshire Hathaway after Buffett steps back, Josh Lipton got a closer look at the bull and bear case on investing in the company with Berkshire shareholder Mel Casey, FBB Capital Partners Senior Portfolio Manager.
I think if you look at the at Berkshire Hathaway, it's primarily an insurance business, but really it's large enough that it's a conglomerate. It's involved in many different places. So there's kind of a cyclicality and a counter-cyclicality within that portfolio. So you could almost even think of it as an alternative to a lower risk alternative to owning the broader market. And you're going to find some of the businesses like the insurance are counter-cyclical, but then other parts like the railroad are going to be more sensitive to the economy.
How would you characterize valuation here, Mel?
So in a year of pretty high valuations for U.S. large cap stocks, I think Berkshire's still pretty reasonably valued. If you look at the estimates for next year, it looks a little closer to the overall market on a price to earnings ratio. They prefer book value. I think that's fair because there's so many different businesses here. On book value, it's around about 1.5 times. That's historically a little bit higher than it had been before. Also, shareholders who pay attention know that Warren Buffett advocates repurchasing stock at 1.2. So it's a little bit above his level. But when you look at some of the other companies that make up the market, it's certainly reasonable, if a little bit higher than it has been in recent past.
And Mel, post Buffett, how does the bench look at Berkshire? Would you say that falls into the bullish column?
Cautiously bullish. We've had a couple of changes in that bench recently. That was a little surprising, I think, to investors. Todd Combs' departure in particular. Been there a couple of decades. You would have thought that this was the exact moment that he was waiting for, but there's been a change there, and that's fine. The bench is still deep. Greg and Ajay, these are very, very seasoned folk. It's reasonable to think that a lot of the values that have brought the company to this point will continue to be in place. We wouldn't expect major changes. Wouldn't be holding out for a dividend, or I wouldn't be expecting major swings and aggressive allocations of capital. But there's definitely a culture in place that I think the bench will probably continue to keep in there.
So we walked through the bull case. Let's talk about the bear case, Mel. Let's outline that one. One concern you have, the risk of losing the Buffett premium. Explain that.
Yeah, there's no question. There's no investor out there. There's no CEO or investor spoken about as much, quoted as often. There's so many books out there. I mean, there's an iconic investor. We lost Charlie not that long ago, Charlie Munger. Warren Buffett is stepping down. And so, and anyone who's been to the annual event in Omaha will testify that it feels different. It's not a regular company meeting. So is there some premium there? You could argue that some of that's been coming out over the course of the year. It's performed about 2/3 of the overall market performance this year. Some of that is related to some of the underlying business trends, which we can get into in a second. But there's definitely a caution out there that some of the core investors are investors in Buffett rather than in the actual fundamentals of the company itself.
That's going to do it for Berkshire Beyond Buffett. Thank you for watching Yahoo Finance.